Hey everyone, I am Sami Abusaad, Director of Education at T3 Live. Welcome to today's video. I am starting a lesson series on the simple art of trading, going over simple stuff initially and then kicking it up a notch with every lesson. Today's lesson is going to be about candlesticks, understanding candlesticks. And I know that you might think you know how to read candles pretty well, but stick around with me for a few minutes and see for yourself. First, why we use candlesticks. Let me get the camera off so you can see. Japanese candlesticks focus on the relationship between the open and the close of a bar, of a single bar, while Western bars focus on the close of a bar versus the prior period's close. And as long as the underlying stock closes higher than the prior day's close, Western thought says it's positive. However, according to the Japanese view, this is not necessarily the case. If on an up day, a stock closes below its open, the Japanese would regard it as negative. The use of Japanese candlesticks help us determine who won the battle between supply and demand, which is the most important element of technical analysis. I underline that for a reason, obviously. So the most important element of technical analysis is determining who is in control, who is winning the battle, the buyers and the sellers. Now, when it comes to Western thought, right, Western bar charts, as long as the stock closes above above the prior day's close or above the last bar's close, they say it's bullish. But according to the Japanese view, it is not necessarily the case. For example, if let's say Microsoft were to open here and then sell off all day, right? Sell off all day to close at the lows here, even though it might have closed above yesterday's high, above yesterday's close, which let's just say it was here, that bar, according to the Japanese view, is not bullish at all. So Japanese candlesticks look at the candles bar by bar on a bar by bar basis, and it all depends on which group is in control. All right. If the stock closes above where it opened, it is said that the bulls won that battle, right? It's always a battle between the buyers and the sellers. If the stock closes below where it opened, it means that the sellers must have won that battle. Otherwise, price would not have dropped. There are 5 things to be aware of when it comes to a single candle, and it is the high and the low, which are the same for whether it's a red or a green candle. The highest high, the lowest low on the candle is the same. The high and the low, whether it's green or red. But if it's a green candle, if it's color-coded green, it means the open must have been at the bottom of that green and the close was at the top of it. And vice versa if it's a red candle. The open is at the top, right, at the start of that red, and the close is at the bottom. That's how you can tell if it's color-coded red, that's how you can tell it closed below where it opened. Now, what's the 5th reference point? That's 4. The 5th is not necessarily a reference point. It is just the body of the candle, right? The difference between the close and the open, that's called the body of the candle, and the bigger the body, the more bullish it is, or the higher the degree by which the buyers won the battle. Okay, so that's just a simple slide on candles. This is another slide that shows you every single type of candle that you can get, basically. The first one formed by the first one opened at the low and rallied to close at the high. There was an absence of sellers, no sellers at all, right? So that's what that means. So all out bullish for sure, all out bullish. Second candle opened here because it's a green candle. I know it opened here, rallied all the way up to the top, and before the candle had finished forming, the sellers showed up and forced prices to close down here. So while the stock closed higher than where it opened, again, it opened here, closed there. So if you bet on the bulls, if you bought the stock, you would have made money. Which group was in control at the end? Was it the buyers or the sellers? You tell me. The sellers, of course. That's number one. Number two, the sellers pushed back and forced prices to close in the bottom third or so. That's a bearish signal, right? That's pretty bearish. Number three, we left a topping tail behind. A topping tail is bearish because it's the negation of what was previously a green bar. Those were buyers that bought the stock all the way up to here, and now they're sitting on a losing position because most people don't buy and sell in the same bar. They buy to hold for another 3, 4, 5 bars, right, before they look to exit. And in this case, now they're sitting on a losing position. So topping tails are bearish because they trap people, because they signal that the sellers basically took back the control. And in this particular case, the candle also closed in the bottom third. So while the buyers indeed won the battle, this particular battle, the message is actually bearish, not bullish. The third and fifth candle are very similar in that we opened here, rallied, sold off, and then rallied back up to close slightly above where we opened, so slightly bullish, right? This is bullish, not too bullish. It really depends on where it is forming in the trend or on the chart. So that's another item that we will discuss later, and it's a location item. Depends on the location. Number 4 is a bottoming tail. This is a green candle, so I know it opened here. Initially was a big red candle, but before that candle had finished forming, buyers showed up and forced prices higher to close at the very top. If that's not bullish, then I don't know what is. This is the ultimate sign of bullishness because not only did it reverse this big red bar, what used to be a big red bar, we also closed at the absolute top. We closed at the top just like this one closed at the top. Okay? But in this case, what's the difference between number 1 and 4? What's the difference between 1 and 4? The difference is that number 4 is battle tested, right? The buyers were battle tested and they won the test. They won the battle. Number 1, the sellers maybe were on a break. They weren't around. What if on the next candle we get something like this? Big red candle. So the first one doesn't show us really the other side of the equation or the sellers. The fourth one shows us the sellers, and it shows us that the sellers were crushed. Number 5 we already went over, same as number 3. Now on the right side of the slide here, the set of red candles is the same as the green candles that we went over, except in reverse, meaning these are all red candles. In each and every case, if you shorted the stock, you'd have actually made money. But in, let's say, number 9, the message, the stock reversed most of the red to close near the top. So the message was pretty bullish. Okay? I would say number 7 was the most bearish, followed by number 6. But it also depends on whether number 6 was an igniting wide range bar or an exhaustion wide range bar. We'll talk about these in upcoming lessons. At the bottom here, we have a bottoming tail and we have a topping tail. If there is no body to the candle, right? If the body is just a black dot, it means we closed where we opened at, right? Opened here, sold off, and then rallied to close at the top, leaving a dark wick, or there's no body here. So the buyers and the sellers, you can say, are evenly matched, but in this case, it is still considered a very bullish candle simply because the buyers took back the control. I like to think of candles as, think of a vacation. when you go on vacation, everything goes right, and then on the last day, God forbid, right, everything goes wrong. You miss your flight, or you have some kind of an accident, whatever. When you look back at that vacation, do you think, how do you feel about it? Would you think of it as a great vacation, or as a, not so great of a vacation? So even if this was, for example, a red candle, when I see something like this, the ending to me is everything, right? The ending is everything. Or even though this was a bullish candle, everything was going great in that vacation, right? On that vacation, but it ended at the end it was pretty bad. So in this case, right, I would think of it as a bearish candle, even though it's a green candle. Again, even though the one on the right was red, it's bullish. The one on the left is green, is bearish. Okay? So those are called bottoming and topping tails. The difference between 1 and 4 is, again, it really depends on how they formed, where they formed. 4 we said is battle tested, 1 wasn't. Here's how 1 forms. You get the red on a smaller time frame, and then it's reversed through green bars. But it could also be reversed if it's reversed through multiple green bars. That's not necessarily as bullish as getting reversed through one igniting bar, like so, and then a base, or a base and then one igniting bar. So again, here, this would be a really good bullish way to form this bottoming tail. Not so much when it happens through multiple green bars in a row. Anybody know why? Does anybody know why? Because when you reverse the red bars, it's nice when you reverse them in just one big green bar, right? Or one big green bar in a sideways base, because it leaves, when you reverse them quickly like that, it leaves the sellers trapped with not much time at all to cover. If the stock reverses, if the stock goes up and with multiple green bars in a row and slowly reverses those red bars, that's bullish, but not as bullish because it gave the sellers time to cover. Does that make sense? The same with a wide range green bar. We don't want it to form after with multiple bars like so. We would rather see it form through just one igniting bar and multiple small bars, or multiple small bars and then one breakout bar. So you have to look at the smaller time frames and determine how the candle actually formed. Okay? In upcoming lessons, we'll talk about other advanced uses for candlesticks. We'll talk about wide range bars, narrowing or narrow range bars, what they mean. And narrow range bars, I like to think of as when a car is making a U-turn. You don't turn the other way. You don't get the reversal unless you actually slow down and then make a U-turn while driving. So narrow range bars often signal the reversal. In fact, the market's biggest moves come from its smallest bars. That is kind of a trading law. The market's biggest moves come from its smallest bars. We'll talk about that in more detail in upcoming videos. We'll also talk about 2-bar reversals and how potent. We'll discuss the potency, the level of potency, the potency of the reversal. When you reverse, when the second bar reverses the red bar in this case. So we talk about the level of penetration, the size of the bar. Again, we'll talk about that in future videos and hopefully just the next video. We'll also talk about, as I said, wide range bars. We'll talk in more detail about topping tails, bottoming tails, and range expansion bottoming tails, which are range expansion bottoming tails are the single most bullish bars you can have. Now, what's a range expansion bottoming tail? We'll talk about that and hopefully in the next video or two. All right. Wanted to keep this video short, and I want to say if you like this video, we have an incredible offer right now where you can trade with me for 30 days in the Strategic Day Trader virtual trading floor. I'm sure you've seen my past videos and the kind of P&Ls, the trades that I call in the room produced. So it all happens in the Strategic Day Trader, which, by the way, was twice voted on by the trading public as the best trading room in the nation. Trader Planet used to put on these surveys, and for 2 out of the 4 years, my room won the best trading room again for 2 years in a row. A link is in the description for how to get this deal. Link is in the description. Check it out. And if you have any questions, reach out to customer service or anybody at T3. Until next time, this is Sami Abusaad with T3 Live. Good trading, everybody.